Did you know that homeowners in the top 10% of earners control over 75% of the wealth in the housing markets? Meanwhile, millions of middle and lower income earners struggle to build equity or lose out on real estate opportunities. Why is that? What if the myths you've been told about real estate are keeping you from building wealth? Real estate is often heralded as the ultimate wealth building tool. Whether it's the security of owning a home or the potential to make a profit through investment properties, real estate is seen as a ticket to financial freedom. But here's the catch. Most people are playing the real estate game based on outdated rules. There are myths, deeply ingrained ideas about how to buy, sell, and invest. That could be the reason you're not seeing the results you want. Buying a home should be one of the best financial decisions you make. Yet many people end up losing money, missing out on opportunities, or worse, becoming stuck in financial ruts. Why? Because they're following bad advice or holding on to real estate misconceptions that are no longer true in today's market. In this deep dive, I'm going to break down the most harmful real estate myths, challenge them with data, and give you the tools to navigate the market smarter. Whether you're an aspiring first-time home buyer, a seasoned investor, or someone looking to sell, the goal is to help you avoid the common traps and make decisions that set you up for long-term success. Myth number 1, you should always buy instead of rent. This myth stems from the belief that renting is throwing money away, while owning a home is a sound financial move every time. After all, if you own property, you're building equity with every mortgage payment, right? The deeper reality. It's true that owning property can be a great way to build wealth over time, but it's not a universal truth. Depending on your situation, buying might actually cost you more than renting. Let's break down why. 1. Market variations. According to data from Zillow and Redfin, certain markets, particularly high-cost urban areas like San Francisco, New York, and Los Angeles, are better suited for renting because home prices are so high that monthly mortgage payments far exceed the cost of rent. For example, ATTOM data shows that in the San Francisco Bay Area, average rent for a 2-bedroom apartment is $3,500, whereas buying a home can easily come with a $1 million price tag, resulting in mortgage payments over $6,000 per month. 2. Additional costs of home ownership. Many buyers overlook the hidden costs of owning a home, which include property taxes, maintenance, homeowners insurance, and repairs. CoreLogic data suggests that these costs can add 1 to 3% of the home's value to your yearly expenses. For a $300,000 home, that's an additional $3,000 to $9,000 per year on top of your mortgage. 3. Mobility and flexibility. If you're unsure about your long-term plans, renting can be a better option. Zillow reports that the average American moves every 7 to 10 years, and if you need to relocate due to career or lifestyle changes, renting provides flexibility without the burden of selling a home. Home ownership comes with transactional costs, realtor commissions, closing costs, and potential market depreciation. That can negate any short-term equity gain. 4. Opportunity costs. Renting can free up cash flow that might otherwise go towards a down payment, allowing you to invest in other areas such as stocks, bonds, or even rental properties in lower-cost markets. According to Altos research, many renters who invest wisely often outperform homeowners in wealth growth because they are able to diversify their portfolio rather than being tied down by a single asset. The conclusion: owning a home isn't always the best option, especially in high-cost markets or for people who need flexibility. Renting can be a smarter financial move depending on your circumstances. Myth number 2, the housing market always goes up in value. Many people believe that real estate is a surefire investment because property values always increase over time. The logic seems simple. Buy a home today and it will be worth more in 10 years. The deeper reality. While the housing market has historically shown long-term growth, it's far from a guarantee that your property will appreciate in value, especially in the short term. Real estate markets are subject to both national and local economic conditions, and values can fluctuate significantly. 1. Historical bubbles and crashes. The housing crash of 2008 is a prime example of how property values can plummet. According to CoreLogic, U.S. home prices fell by as much as 30% in some markets between 2007 and 2009, wiping out trillions of dollars in equity. This crash was triggered by subprime mortgages, but it highlighted a bigger issue. Real estate is not immune to market downturns. 2. Local market conditions. Real estate is hyperlocal. While national trends may show home price appreciation, certain areas experience stagnation or even declines. For example, cities like Detroit and Cleveland have seen decades of property value erosion due to population decline and economic downturns. According to data from Zillow, between 2000 and 2010, the median home price in Detroit dropped by more than 50%. 3. Market saturation. Some cities are now experiencing market saturation. CoreLogic reports that markets like Miami and Las Vegas, which saw rapid home price increases in the early 2000s, have struggled to recover fully from the 2008 crash. Even today, home prices in these regions are volatile due to oversupply and investor speculation. 4. Inflation and rising interest rates. Inflation and rising mortgage interest rates can also dampen property value growth. Altos Research and Redfin have noted that as interest rates increase, affordability decreases, reducing demand for homes and potentially leading to slower appreciation or even price drops. Conclusion. While real estate can be a strong long-term investment, the idea that property values will always go up is a myth. Markets fluctuate, and timing, location, and macroeconomic factors all play a role in determining whether or not your property will appreciate in value. Myth number 3. You need 20% down to buy a home. For decades, the idea that you need a 20% down payment to buy a home has been drilled into potential home buyers. The rationale is that putting down 20% avoids private mortgage insurance and gives you better terms on your mortgage. The deeper reality. While putting down 20% does have its advantages, it's no longer a hard and fast requirement. Many buyers today, especially first-time home buyers, are purchasing homes with far smaller down payments. 1. FHA and VA loans. FHA loans, backed by the Federal Housing Administration, allow buyers to put down as little as 3.5%, while VA loans for veterans can offer 0 down payment. According to Zillow, nearly 60% of first-time homebuyers in 2020 put down less than 6%. These government-backed programs make homeownership accessible to a wider range of buyers, particularly those who can't afford a large down payment. 2. Rising home prices. In fast appreciating markets, waiting to save 20% can be counterproductive. If home prices are rising by 5 to 10% per year, Waiting another 3 or 4 years to save for a bigger down payment might mean that the home you could afford today will be out of reach by the time you save enough. 3. Private mortgage insurance. While PMI does add a cost to your mortgage, if you put down less than 20%, it's less significant than the opportunity cost of waiting to buy. According to CoreLogic, PMI rates typically range from 0.5% to 1% of the loan amount per year. For many buyers, this additional cost is manageable, especially if it means they can enter the market sooner. 4. Building equity sooner. By buying with a smaller down payment, you begin building equity sooner. Redfin data shows that even with a 5% down payment, homeowners can gain equity within a few years as they pay off the loan and as the property appreciates in value. Conclusion: you don't need to wait until you have 20% saved to buy a home. With low down payment options available, you can enter the market sooner and start building wealth faster. You just make sure you budget for additional costs like PMI. Myth number 4, buying a fixer-upper will save you money. Thanks to popular home improvement shows, many buyers believe that purchasing a fixer-upper is a shortcut to building equity and saving money. The idea is that by purchasing a home for less and investing in renovations, you'll increase its value and come out ahead financially. The deeper reality: while buying a fixer-upper can be profitable in some cases, it's far more complicated and risky than it appears on TV. There are significant financial and logistical challenges that can turn what seems like a deal into a money pit. 1. Underestimating renovation costs. According to CoreLogic, the average renovation project costs 20 to 30% more than initially estimated. Unexpected issues like plumbing, electrical, or structural problems can quickly escalate costs. In fact, a survey by Home Advisor found that nearly 70% of homeowners who renovated spent more than they planned. 2. Time and stress. Renovating a home takes time, often months longer than expected. Living in a construction zone, coordinating contractors, obtaining permits, and dealing with delays can cause significant stress and add costs. For example, Altos research found that the average home renovation timeline is often extended by 3 to 6 months due to unforeseen issues, especially in older homes. 3. Opportunity costs. While you're waiting for renovations to be completed, you're not building equity in a completed home. Zillow data shows that homes in move-in condition typically appreciate faster than fixer-uppers during the renovation process. If the market shifts during the time it takes to complete your renovations, you could be at a disadvantage when it's time to sell. 4. Financing complications. Many people underestimate the financing hurdles that come with buying a fixer-upper. Most lenders are wary of financing homes that need significant repairs. While renovation loans like the FHA 203 or Fannie Mae's home style loan exist, they come with their own challenges: higher interest rates, more paperwork, and stricter guidelines. According to Business Insider, buyers who use these loans often face delays and additional costs that can outweigh the potential equity gains. 5. Resale value may not be as high as you think. Even if you complete the renovations on time and within budget, there is no guarantee that the home's value will increase as much as you expect. CoreLogic points out that buyers often over-improve homes in ways that don't align with neighborhood standards, leading to diminished returns. For instance, adding high-end finishes in a middle-income neighborhood might not raise the home's value as much as anticipated. Conclusion: buying a fixer-upper is not always the best way to save money or build equity. The costs, time, and risks associated with renovation can quickly add up, and you could find yourself spending more than you would have on a move-in ready home. It's essential to carefully evaluate the true cost of a fixer-upper before diving in. Myth number 5, real estate is a passive investment. Many people are drawn to real estate with the belief that it's a set it and forget it investment. The idea is that you buy a property, rent it out, and sit back while the rental income and appreciation build wealth over time. The deeper reality: while real estate can generate passive income, it's far from a hands-off investment. Managing properties, whether it's a single rental or multiple units, requires ongoing time, effort, and resources. 1. Landlord responsibilities. Owning a rental property comes with the responsibilities of being a landlord, which can quickly turn into a part-time job. You'll need to manage tenants, address maintenance issues, collect rent, and comply with local regulations. According to data from Altos Research, the average landlord spends about 20 hours per month on property management tasks. That's hardly passive. 2. Vacancy risks. One of the biggest misconceptions is that rental properties will always generate income. In reality, vacancies can eat into your profits. Zillow data shows that the average rental property experiences at least 1 to 2 months of vacancy per year. During this time, you're responsible for covering the mortgage, property taxes, and maintenance without any rental income. 3. Maintenance costs. Property upkeep can quickly erode your profits. CoreLogic found that landlords spend an average of 1 to 2% of the property's value each year on maintenance. This includes routine repairs as well as larger expenses like replacing a roof, HVAC system, or appliances. If you're not setting aside enough money for maintenance, you could end up in financial trouble when major repairs are needed. 4. Property management fees. If you're truly looking for passive income and don't want to manage the property yourself, you'll likely need to hire a property management company. These companies typically charge 8 to 12% of the monthly rental income, according to Redfin. While this can alleviate the burden of being a landlord, it significantly cuts into your profits. 5. Market fluctuations. Real estate isn't immune to market downturns. Just like any other investment, property values and rental demand can fluctuate. Business Insider points out that in economic downturns, rental vacancies can rise and property values can decline, leaving investors with negative cash flow. Conclusion: real estate is far from a passive investment. Whether you're managing tenants, handling maintenance, or dealing with vacancies, being a landlord requires ongoing time, energy, and financial resources. If you're not prepared for the responsibilities of property management, real estate may not provide the passive income you're hoping for. Myth number 6, you should wait for the market to cool down before buying. This myth is based on the idea that you should wait for the perfect time to buy, usually when prices drop or when there's less competition in the market. Many potential buyers sit on the sidelines hoping to time the market just right to get a better deal. The deeper reality: while waiting for a market correction might seem logical, trying to perfectly time the real estate market is a risky strategy. In fact, waiting could end up costing you more in the long run. 1. Market timing is nearly impossible. Redfin data shows that even the most experienced real estate investors struggle to predict market movements accurately. Housing markets are influenced by a complex set of factors, including interest rates, inflation, local job markets, and national economic trends. By the time a cool down happens, prices may have already adjusted, or the market may not cool as much as you anticipated. 2. Missed equity gains. According to CoreLogic, home prices in the U.S. increased by an average of 7 to 10% annually in recent years. If you wait even 1 or 2 years for the market to cool down, you could miss out on significant equity gains. Altos research found that buyers who waited for a market correction in 2020 and 2021 ended up paying significantly more as prices skyrocketed during the pandemic-fueled housing boom. 3. Rising interest rates. Even if home prices do drop slightly, rising mortgage interest rates could offset any savings. In 2022, Redfin reported that as interest rates increased, monthly mortgage payments rose significantly, even as home price growth slowed. For example, a 1% increase in interest rates can raise your monthly payment by hundreds of dollars, erasing any savings from a small dip in home prices. 4. Opportunity costs of renting. If you're waiting for the market to cool, you're likely renting in the meantime. While renting can be a good strategy in certain situations, you're not building equity as a renter. According to Keeping Current Matters, homeowners on average build 40 times more wealth than renters over a 30-year period due to equity growth and appreciation. 5. Inventory shortages. In many markets, waiting for the market to cool down could mean missing out on limited inventory. Zillow data shows that inventory shortages have been a persistent issue in many parts of the country, particularly in desirable urban and suburban areas. If inventory is low, waiting could result in even higher competition and higher prices when you finally decide to buy. Conclusion: waiting for the market to cool down is a risky strategy that can result in missed opportunities, higher costs, and lost equity gains. Instead of trying to time the market, focus on your financial readiness and long-term goals. If you're financially prepared and plan to stay in the home for several years, now could be the right time to buy. At this point, the reality should be clear. Real estate is full of nuances and complexities that don't fit neatly into the myths we've been told for years. The most important takeaway is that real estate success isn't about following one-size-fits-all rules. It's about understanding your personal situation, doing your research, and making informed decisions based on today's market conditions, not outdated beliefs. The powerful insight is this: real estate is a personalized journey. If you're making decisions based on myths, you're playing someone else's game and limiting your potential. Whether you're buying, renting, or investing, the key to success is understanding the market, evaluating your financial situation, and crafting a strategy that works for you. I've just debunked some of the biggest myths that keep people from building wealth in real estate. From the idea that you should always buy instead of rent, to the misconception that you need a 20% down payment. It's clear that many of these beliefs are rooted in outdated thinking. Real estate can be a powerful tool for building wealth, but it's essential to approach it with a clear, informed strategy. By understanding the realities behind these myths, you can avoid common pitfalls and make smarter, more profitable decisions in the housing market. So, what real estate myths have you heard? Share your experiences in the comments and let's start a conversation. If you'd like, watch another video or share this one with someone who may benefit from this information. My name is Giovanna and I'm with the Signatory Group. Thanks for watching. Bye.